Hey folks, hope you all are doing well. I'm Karan Bandal from Econosite, your weekly economic wrap from India and around the world. So let's get started with some analysis. Deloitte assesses India's economic outlook. Deloitte Insights just released its comprehensive assessment on India's economic outlook for the next 4 to 5 years. The report makes 4 key points. Let's take a look at them one by one. First, GDP revisions reveal India's resilience. India recently came out with GDP estimates for October to December quarter of calendar year 2022 along with revisions of the past 3 years data. In peak COVID, during financial year 21, India's GDP contracted by 83 basis points less than the initial estimate. Later on, during financial year 22, India's GDP expanded by 29 basis points more than the initial estimate, implying not as deep a recession as previously thought and a stronger rebound than previously known. This rebound was driven by a stronger than anticipated growth in manufacturing and construction. A few key observations here. Despite the global slowdown, exports did extremely well. Goods exports remained modest while India's services exports skyrocketed by 30% between April and February. Companies globally now prefer outsourcing to India a wide range of professions such as accounting, audit, research and development, quality assurance, and after-sales service in their quest to cut costs in a slowing global economy. Also, India's central government is playing a prudent role here. Gross fixed capital formation or asset creation continues to go up. At the same time, you can see government spending is going down for the last 2 quarters, indicating the government's move towards fiscal consolidation while maintaining the pace of capital expenditure. Second key point, what will drive India's growth in the future? It is the growth in investments. India's domestic demand will rise with a rising population, and unless the country invests in supply-side assets, the desired growth will not materialize. Then what is stopping private investment? Well, a rapidly tightening monetary policies across industrial economies of US, EU, UK, Japan, etc. have led to a global liquidity freeze, making it expensive for businesses to borrow. Rising geopolitical uncertainties are leading to restructured supply chains and altered trade flows, thus obscuring future demand for products and services. Supply chain issues and the shift towards renewable energy sources have caused production costs to escalate. All this deters investors from investing in futuristic projects. But not all is bad with India's corporate world. Corporate profits are up, their balance sheets have gotten healthier, banks are doing better as their non-performing assets continue to decline. All that to say, banks are willing to lend and corporates are in a position to borrow and invest if they so choose. That brings us to key point number 3. What can the government do to facilitate the investment cycle? Start with a well-balanced monetary policy. In the current inflationary environment, the Reserve Bank of India or RBI is unlikely to let its guard down. But too much tightening, that is continuing the policy rate hikes, will result in a vicious circle of low credit availability leading to low investment, which will lead to low supply and thus high inflation. The RBI's latest move to pause the rate hike cycle is therefore well received. On the ground, you can see foreign direct investment or FDI trending down as global liquidity is drying up. This private and foreign investment gap has to be filled up by the government through higher spending on infrastructure. Government has been on the money on infra spending through various initiatives, and they have budgeted a whopping $120 billion in capital expenditure for the ongoing financial year. Finally, government needs to focus on services exports also. While production-linked incentive schemes are showing encouraging results in some sectors like electronics manufacturing, the export growth seen in services sector has surprised the observers. It needs further policy support from the government so that India can reap benefit where it has a comparative advantage already. The final key point attempts to make an educated forecast on India's future GDP growth and inflation. Despite all the uncertainties, India's growth drivers have maintained a positive momentum as evident by the high frequency data such as electricity generation, GST collections, purchasing managers index, etc. This should encourage and kickstart the private investment cycle in the next year or two. So, considering all the factors, India's economy is poised to grow between 6 to 7% for the next 4 years. On inflation, since India's demand is unlikely to falter and investments will take time to bring supply online, price rise will decline at a slower pace with inflation staying close to a range of 5 to 6% for the most part. Let's end with a deep dive into one of the high frequency indicators we just mentioned. In April 2023, Goods and Services Tax or GST collections rose 11.6% to a record high of 1.87 lakh crore rupees. This is the highest GST collection ever since the implementation of the Goods and Services Tax in mid-2017. The state of Maharashtra leads in GST collections, but some of the smaller states and union territories reported higher growth, with Sikkim clocking a 61% increase. Overall growth in GST slightly slowed from what was seen in March 2023 when GST had grown by 13% to 1.6 lakh crore rupees. But a continuing growth in India's tax collections in a slowing global economy is one more data point in support of the claim that India will remain the fastest growing major economy in the medium term. The global economic environment is difficult. Geopolitical tensions and war further adds to the economic headwinds. India will stand out if India's private investment picks up. If India demonstrates a 6+% growth in this economic environment, global capital will flow in. For now, India's economic indicators are moving up and we will track them right here. I hope you found this week's wrap interesting. I'll speak with you again next week. Until then, take care.